Well, hello, Stacey Murphy here from Dreaming Earth Incubator. Today's presentation, Milestones and Stages of Investment, What to Expect When You're Fundraising. And here's why this is so important. So if you were to go to your first trapeze lesson, which is something I love to do, would you expect that you could show up not knowing anything and be able to jump off the platform at the exact right time, do the exact right thing in the air, and then do the exact right thing to get caught and tell that person when to go so that you knew when to get caught? Would you expect to be able to do that? Well, probably not. And if you go to your first trapeze lesson, by the way, they will talk you through it and they will talk you step by step. This is something you can do on your first time ever because you know the steps and you know exactly what to do and you practice it. So that's what this presentation is about, is knowing the steps ahead of time so that you know what to expect. And this is what I'm wanting you to avoid, is the oops face when you realize that you did something at the very start of creating your business that now affects your positioning and you don't have a good solution any longer. So this is what we're trying to avoid. And there's when you're working on your, especially your cap table, this can really lead to some trouble down the way. So the agenda today is investor profiling. This is where you get to imagine your ideal investor and get into their mindset to understand who they are and what they're looking for, what their goals are. Milestones at each stage of investment to understand how investors see you and how they measure your success along the way, and how you know when you've gone from one stage of investment to another. Then we'll talk about cap tables. We're not going to go too deep into this. CAP stands for capital. This is what you need to know about the role of your CFO when starting a new business. So it's much different than existing corporation when you're a startup. And then how to ask. This is all about finishing your pitch very strong. And this is something that a lot of people get wrong and not many people focus on this. So I want to make sure you get this right. And then finally, next steps, your refined pitch deck and refining what your ask is for your project. So first up, let's talk investor profiling. So I like that it's profiling. It's just kind of a funny word, right? Usually it means something bad, like that we're doing something bad. We're profiling. But in this case, we're imagining your ideal funding partner. And so I want you to find some delight in this process and make this as fun as possible for yourself, all right? You could do this with a guided visualization, and you could also just sit and daydream as we talk about this slide here. So imagine for a moment that there is a version of yourself who is with you now, and that version already has all the investors in their business, and they are just rocking and rolling along the way, and that investor has contributed so much. That investor has maybe contributed financial help. That investor has possibly given expertise or networking, connecting you to people. And imagine yourself for a moment sitting there enjoying a dinner with them. And just feel what it feels like to sit next to somebody who you know believed in you before anybody even knew who you were and gave you what you needed to get moving. So just imagine yourself sitting there at dinner with that person, and imagine also that they are talking you up and they are basically sharing your information with other funders, that they are maybe, as you're having dinner, they're saying, what do you need now? And you're like, well, I could really use some help with X, Y, or Z. And they're like, hold on a second, let me just call my friend, and doot, 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 and they call. So imagine yourself out to dinner, just having fun with this person, enjoying their presence, and playing with them, which is essentially what you're doing. And then take a moment too to imagine you're sitting here having dinner with this person. So this is somebody that you would enjoy being next to. This is somebody you would like to spend time with. This is somebody you might even, who knows, go on a boat trip with, or so many different things. You might go to a conference together. There might be lots of different places where you spend time with this person. You might even get to know their family. And so just imagine for a moment what you would prefer their values to be. what you would prefer their behavior to be in different scenarios, and what you would prefer that their existing portfolio looks like and what their goals are. So every investor has what's called a thesis, investment thesis, and that's what their goals are. They're trying to prove that thesis out. And so you get to decide how you fit into that thesis. And then imagine for a moment that their investment thesis matches you and your startup perfectly, where they are like, wow, this is exactly what I've been looking for to leave a legacy on the world, to fill a gap that I perceived in my vision of the future, and this business fills that gap. So imagine yourself being that missing piece for them, something where when they get introduced to you, their heart kind of skips a beat a little bit and they're like, ooh, this is exciting. So imagine that for a minute, because oftentimes we feel like we're chasing money as the solution to our problem, but that's not it at all. We're building relationships and we're spending time with people that we enjoy spending time with. And that's what I would recommend you imagining along this way. Okay, so as you start to imagine that person, you might actually start to meet some people who fit your profile or don't fit your profile. And you want to have a tool that you can assess. And so some people can do this mentally and keep this all mental. Other people have spreadsheets, and it would be a spreadsheet that would have all these different tabs, and then you'd fill out the name and the details. So the most important profiling piece that you need for your investor is of course you want their name or the name of the group that's investing. You want to know what is the average check size that they write, because you want to know that you are in the ballpark at the right timing. So what stage do they invest in? Do they invest in pre-seed, seed, Series A? Where do they invest? And what size check? And that way you'll know, wow, I don't even fit in this person's the investment thesis, and so I don't even need to pitch them. But you might decide they have similar values and goals as people I would like to be my investors, and maybe they know somebody. So I might send them the pitch deck and say, if you know of anybody who might be a good fit for this pitch deck, let me know. So you really want to understand your investor. How much money is an average check size for them? What's the smallest check they wrote? What's the largest check they wrote? What's the middle check? What stage company? Because usually they like a particular stage. Investors usually like a particular stage because they know that at that stage they know how to help that startup, and they know what metrics to look for that startup to be successful. So they have some experience there. And then it's great to know their portfolio size overall. So what percentage are you of that portfolio? Are you a small piece of it? Are you a big piece of it? How do you feel about that? If you're a tiny piece of it, do you feel like, is this investor going to be available to help you when you need them? Do you need their help? Maybe you don't. Maybe you just need that check from them. And then some examples of things that are in their portfolio. So those are things that match their thesis. So typically an investor will have a thesis like, I invest in early stage startups that have had 10x growth in their leads or something in the first year, or they've had 10x growth year after year for 3 years. Or I like to invest in early stage startups with a novel patent that I see that could be a leader in the industry. So it could be lots of different things. And then you start to list the different things that you know about this investor. What are their behaviors currently as an investor? What are they doing? Their goals within their portfolio. What kind of goals and needs do they have? You can ask them specifically, what's your thesis? And what are the goals of your thesis, and what are you looking for right now? So those are questions you can ask your investor. So when I meet an investor right up front, I want to know, what's the check size? What's the stage? What kinds of projects are in their portfolio, and what kinds of needs do they have that they want to meet? And sometimes I'll even get really straightforward and I'll ask them, how much money are you looking to invest in right now? Like, how much money is liquid right now that you're looking to invest? And then I like to write down their values. And these are things that you have to experience for yourself with them. And just notice, is this somebody who is really kind no matter what? Is this somebody who loves to talk about leaving a legacy? Is this somebody who loves to talk about mental and physical wellness, and they have a watch, smart watch that's measuring everything? Like, start to notice what their values are by how they're behaving. And are those the kinds of investors you want? And then notice what kind of industries they're investing in. Is it SaaS? Is it fintech? Is it green tech? Is it regenerative ag? And so you want to know where you fit in that. And then I always add another layer to this, which is some personal details and anything else that I think is important that needs a box. So what are their kids' names? How do they spend their time? What are potential gift ideas? Those sorts of things. And this is all about building those relationships. Okay, so what role will this investor play for you? So it's possible that they may fund you. That's capital. It's possible they may be an advisor, and they might want to join your board. They might want to join your advisory board, so you can ask them those questions. They might be able to help you recruit the team that you need for the next stage. They might be a connector to help you connect dots. They might help you with PR. They might have a bunch of media connections. And they might be a tech expert in a certain area. So those are all things that you could also notice about them and add to your document. And then it's really important to understand the distinction between an angel investor and a VC. So an angel is an individual providing their own financial resources to help fund startups or business expansions. Some may be wealthy relatives or friends. Most are experienced investors accredited by the Securities and Exchange Commission. That's the technical angel investor. And angel investors typically bridge gaps between the friends and family round to the seed round, so like the pre-seed to the seed. Angel investors typically range from $25K to $1 million or $2 million, but it varies depending on the industry. It could be more depending on the industry, because some industries need more capital to do more testing and research, like construction products. Many angel investors are motivated by ROI, so they want to see, 10x ROI or whatever they want to see. They're motivated by return on investment, and then they can also add support and mentorship to your team. Now, venture capital is a little bit different. So VC, this is a professional whose role it is to invest in a new or growing business that has a realistic potential for high profits. This is like a big market move. A VC firm uses funds that are gathered from a variety of sources, including large corporations, wealthy investors, family practices, investment corporations or subsidiaries of investment banking firms, pension funds, insurance companies, or other similar resources. And venture capital firms typically focus on specific industries because they get to know them, or they focus on a stage, pre-seed, seed, series A, etc. Or they might focus on a location because they know that location really well. There's an ecosystem there of entrepreneurs. Or they focus on founding teams. So they might be focused on military, like veterans. They might focus on women. They might focus on immigrants. They might focus on entrepreneurs who've already had one successful exit. So they have a particular thesis themselves that they're trying to use. Now, when you are talking to your investors and asking them questions, one very, very key question that you want to ask is, do you invest in the horse or the jockey? And what you mean by that is, do you invest in a business idea or do you invest in the founder? And the reason why this question is so important is because if your investor says that they invest in ideas, that means that they might be willing to replace the founder at a given time if it's the right move. But if they say, I invest in the founder, then you know that they're bought into you and they want to work with you, and your business idea can twist and turn and pivot as it needs to over time, and they'll stick with you. It's not necessarily the idea, it's you. So it's very important to know this about your investor. And would love to end this with alternative funding. So with everything I just talked about, angel investing, VC funding may not be for everybody. And so you might be going a different route, and that's okay. When you bring investors in, when you bring VCs in, you are going to more than likely dilute your equity. And so you might not want to do that in an early stage. There are some alternative terms and asks that you could ask an angel investor during a pre-seed that would not dilute your equity, and I'll talk about that later. So right now, just imagine there are other funding partners that might be right for you at this scale. So crowdfunding platforms like Kickstarter and Indiegogo can help you if you have a product idea and you want pre-orders, essentially. And then you've got things like equity crowdfunding platforms like StartEngine, WeFunder. They're similar, except they're micro investor kind of platforms where that equity is spread over a lot of people. You've got revenue-based financing. This is one I love for things like if you're starting a restaurant. A lot of them use revenue-based financing or some other food product because what that means is that you're going to borrow a chunk of money from them and you're going to pay it back, and the terms are you're going to say, I'm going to pay you back up to 3 times your money or 10 times your money or whatever that multiplier is. And I'm going to start to pay you when we make revenue, and I'm going to pay you 3% of my revenue every month or every quarter, and then I'm going to keep paying you until we reach that 3x or 10x or whatever it is. And you can even gradiate it where you're like, I'm going to pay you 3% of our revenue for the first year, and then 6% the second year, and then 10% the third year, so that you're paying them off quicker and quicker. And so that's a way to mitigate the risk of, if this business never makes any revenue, then there are other ways to handle the debt that you have to that person. Okay, there are impact investors who focus less on ROI and focus more on leaving a legacy on the planet, who are not as necessarily dedicated to that ROI. And so you can make alternate deals with them. Debt financing. So straight up, if you know that you have a business model, and if you know that within the first 3 months you're going to start making revenue, then you might decide, you might run a model, a financial model, and you might see that you can just go to a bank, show them the business loan, get debt financing, and then pay them back month over month. This, I would recommend having your revenue very planned out so that you don't find yourself having a hard time paying that back, because that will be tough if you can't. Line of credit. So going to the bank and saying, I'm starting a new business, here's a business plan, I would love a line of credit for, I don't know, $20,000. And this would be something where you just need a runway to get off the ground. This is something that you would pay back. The difference between debt financing and a line of credit is that you get to pay off your line of credit when you decide to pay it off. And so you just want to make sure it's a true line of credit, not something where you have to make the monthly payments. And then there are accelerators and incubators. So there are some accelerators and incubators that say, we will give you X number of dollars, and usually so this is an incubator that you're in now, but it is different than other incubators. Usually incubators have a fee where you say, okay, you're going to get incubated, and then the incubator is going to receive 3% of your cap table, or the incubator is going to give you at the end of the incubator $500,000 in return for X percentage of your business. So it's very similar to having an investor in that they have some sort of equity stake, but it is another form of funding. And of course, there's grants. So Small Business Innovation Grant, SBIR, is one in the United States that's very recommended for people who have a novel, patentable idea and need some money for testing and development. And then pre-orders. So if you have a product and you know who needs it, and you know you need $500,000 for research and development, you could go out and get orders for a number of products and get that money up front and then basically deliver those orders on the back end. So those are the alternate fundings. And so this is the mindset that you want to be in around imagining the funding source that is going to be right for you.